Check, check, 1, 2. Super, the door is closed. That means the next 40 minutes, you're mine. Hours. Sorry, I'm German, I do the joke sometimes. Well, good afternoon, ladies and gentlemen. A very warm welcome to our hot topic, challenges of private markets. We have 40 minutes together, and we will reserve some time towards the end to answer all your questions. So if I can encourage you already now, as we go along, to think about what you would like to challenge the panelists afterwards. My name is Manuela Froehlich. I lead fundraising at Align. We are a specialist private debt manager focused on secure lendings for movies and television productions. Everything about that later. But I'm also co-founder of Forefront, the leading career network of women in finance in DACH and Luxembourg. So this topic, private markets, is very close to my heart. Now let me introduce my panel here. Thomas Erdmann is Global Head of Asset Management, Sales and Relationship at Clearstream Fund Services. Thomas believes private markets should not be reserved only for institutional investors. Yet, we need to ensure the foundation is in place, in particular, understanding of the attributes of the asset class and a strong, scalable platform backbone that can handle them. Welcome, Thomas. Great to have you with us.
Thanks, Manuela.
You are allowed to clap if you want. See, there's just more energy in the room. Next to him is Stephanie Bilgin, Senior Advisor Private Markets at LGT. Stephanie underlines, broadening access to private markets is a major opportunity, but only continuous transparency and investor education can prevent misleading public market comparisons and secure lasting success. Thank you for joining us today, Stephanie. Just a quick note for all those who are standing here, there's enough space here, so because we're standing 40 minutes, you don't have to. So joining us as well today on the panel is Michael Gruener, the co-CEO of Titan Bay. And Michael emphasizes, building scalable infrastructure for trading semi-liquid private market products requires knowing your client and knowing your trade. More broadly, the ecosystem in its entirety has to work together to provide straight-through processing solutions for clients. Glad to have you with us, Michael.
Thank you.
And completing the panel is Lulu Wang, Head of Private Markets, Portfolio Research and Strategy at Aberdeen Investments. Lulu points out, resilience is key in today's investment landscape. Private markets require thoughtful navigation. Illiquidity and cash flow timing demand strong pacing and careful liquidity management. Welcome to the round, Lulu.
Thank you.
Yeah, before we dive in, I would love to have a quick show of hands. Who already has an allocation into private markets? Yeah. Who is currently evaluating it? As in soon? Few. Is there anybody who says private markets are currently overhyped? Wow, this is really good. One. Okay. So that tells us something important for the panel, that private markets is no longer a niche. They are embedded in portfolio discussions, but the acceptance is yet far from uniform, so this tension we want to unpack today. And you all sit at different points in the private markets ecosystem. So in your day-to-day role, where does it currently feel most stretched or under pressure? And Lulu, may I start with you?
Sure, thank you very much. Hello, everyone. Good afternoon. It's absolutely a pleasure to be here. So despite my look, I actually live in Edinburgh in Scotland. So here we go. I'm here to representing Aberdeen on the private market front. So as a team, we manage various kind of multiple strategies in private markets. So we are certainly a dinosaur in the sector. So as private market has been growing the 30 years of phenomenal growth, I think it's healthy to take a breath and reflect what's actually we've achieved, or indeed what kind of challenges we might have. Now, from a market perspective, private market and in the bonnets is actually across different asset classes, so private equities, credit, real estate, infrastructure, and natural resources. So therefore, I think for the PE, which has gone through some fundamental change in the last 3 years, private credit is a very interesting topic. We can need another 30 minutes for that one. But I think there's different sleeves. Certainly there's some kind of more scrutiny required for private credit. Real estate and also infrastructure, and those are really fundamental real assets, which really can connect to day-to-day life, which are fundamental to our lives. So therefore, overall, I think it's very interesting. In terms of challenges, I think all our panel probably agree. There's various kind of transparencies, liquidity, which I mentioned in my statement already, as well as the valuation principles. So I leave some scope for my panel to discuss, but absolute pleasure to be here. Thank you.
Thank you so much, Lulu. Michael, what is your take, or what does it currently feel most stretched for you?
Yeah, I think most stretched for private market is probably the operating environment as a whole. And that goes from pre-trade, trade to post-trade. I think there is enough breadth of product. Lulu mentioned it, be it private credit, private equity, infrastructure, real estate. There is enough product there. I think the operating environment which Europe is operating on has never been built for private markets to start with. It has been built for mutual funds. It has been built for ETFs, but not private markets. And this is where I think the environment is most stretched. Now, it is also true that it is possible to invest in private markets today. I think for anyone here in the audience, like you can trade private market closed-end, semi-liquid through Thomas at Clearstream today. Where the challenges arise is once you try to scale that up, you trade more volume, you have more trades, you have more clients. All these manual processes which are required today are kind of breaking. So right now, the industry is working, but for wealth management, the industry today is not really scalable.
Thank you. Stephanie, as a private advisor, how do you see that? What is your day-to-day challenges?
Yeah, thank you. In my role within LGT Private Banking, my two main stakeholders are on one hand the GPs who are managing the funds, and on the other hand the private clients. And I think currently, or in the last couple of months, we had most discussions about performance as well as public perception. So I think those are certainly the two pressure points at the moment. Performance, given we had an environment in the last 3 years which was also affecting private markets. We had public equity which really outperformed in a broad sense private markets, and that for sure was a main area where we had conversations. Of course, there is a lot of optionality in private markets. It's also very important to understand those nuances once you invest. But that was one point. And then the second one, public perception. I think the more accessible, the more mainstream, the more public media is also discussing the topic. And sometimes we have client discussions about headlines, which triggers some complications because the viewpoints are not always fully informed.
Yeah, thank you. We'll cover that later. So Thomas, from your perspective at Clearstream, what is where you feel most stretched or under pressure, and what is in your day-to-day role? How does it look?
We haven't rehearsed this, but I would slightly disagree with Michael. I have a nuanced view on this. I mean, Clearstream, to put it in perspective, we're the largest fund processing platform on the planet with 4.5 trillion of asset that we process. Out of this is about 10% alternatives in private markets, right? Different things, also classical real estate, but we can process this in a scalable fashion. I think where I would agree is when it comes to the intersection between the institutional world and the wealth channel. This is where we see, and this is, I think, where we will also talk more about. But generally, where I'm most stretched is actually onboarding all these GPs, all these private market players that want to access, in particular, the Swiss wealth market, the Swiss banks, where we are a gateway, and where you have to have a bridge in terms of education, how you bring those two worlds together, right?
Yeah.
The institutional one, where we handle these products for decades, and the wealth channel, where you need to get until the last mile, right, to the client.
Excellent. And then for those newer to the private markets, and for all those standing here, there's still a few seats here, so I'd like to welcome you to sit down if you want to. So for those newer to private markets, what makes investing here fundamentally different from public markets, and why does it matter, Lulu?
Thank you. For a person who's been breathing private market for the last 30 years, so I'm not biased at all for this. I think private market offers a huge diversification benefit compared to public market. Now, we invest in many, many business. I think from the Ubers, Airbnb to X-Space, to actually in our book, we have seen Rootbox with US in venture capitals, as well as Actions currently still in our book. So huge, very exciting business that has lots of growth. So therefore, value creation is the first foremost. Secondly, I think it's income generation. This is especially true with private credit, real estate, and also infrastructure. So give you long-term, very stable income for your need. I think lastly is inflation protection. Many of the investment, either as private capital or in real asset, those are inflation linked. So therefore, in an environment is higher inflation than we expected, huge amount of political risk, and a lots of pressure, I think, uncertain in the world. To building a resilient portfolio in the private market is ever so important than ever. Thank you.
Excellent. Stephanie, from your angle.
Yeah, maybe to add on that, I think one element which is quite crucial is the accessibility still. Even if vehicles become more accessible to private wealth, I think it still very much depends on whom you partner with. And the dispersion between managers in private markets is huge compared to public markets where everybody tries to beat the benchmark. So there, certain selectivity is really important. So that's one element. And maybe a second one to highlight is valuation methodology. Despite the fact that vehicles become more accessible and also tradable in private markets, still it's private assets, it's companies who normally report quarterly, if not half yearly or yearly. So despite having a more frequent price, the underlying valuation methodology is still very often quarterly or even like fundamentally also yearly. So there is sometimes a misperception of what it means to have monthly NAVs now compared to half yearly or quarterly.
Michael, what would you like to add on this from your angle?
Yeah, when looking at it from a regulatory/operational perspective, I think the fundamental difference between private markets and publicly available product is the following. So UCITS 3 mutual funds, ETFs, anyone can buy them. Number one, nobody needs to know who you are. You can be a retail investor, you can be a professional investor. It doesn't really matter. You have access to that product. You have access to that product every day. So contrast that with private markets. There is investor protection on both ends, the regulator on the one end and the GP, i.e. asset manager, on the other. Both of them have reasons, i.e. illiquid nature of the underlying, to protect the investor. The regulator says, I need to know who the investor is. Is it a retail investor? In Germany, is it a semi-professional? Is it a professional investor? So that's a requirement from the regulator. Who is the investor? And from the GPs, there's another requirement which says, I wanna protect my investors in the fund, so not everybody can redeem as they please. Even if I offer some form of liquidity in semi-liquids, evergreens, I still need to know when you bought, i.e. are you still in hard lock? Are you still in soft lock? How big is your redemption penalty? So just a couple of examples. These two things come together and they all lead to one thing. You cannot trade this on the existing mutual fund rails, which were built to create efficiency, i.e. everything could be aggregated. Omnibus accounts made sense because I don't need to know who is behind it and when it was bought. That's different in private markets. I need to know who you are, whether you are a retail or an institutional client, and I need to know when you bought. And Manuela said it, know your client, know your trade. That means entirely different trade architecture, which is what we are building, and this is kind of where the whole thing is getting manual today in the market because these systems haven't been fully built. And when I say the whole industry needs to work together to build those systems, I mean settlement trading platforms like Clearstream, technology providers like us, GPs, everyone needs to work together to make this scalable. Otherwise, the industry is not going to grow to where it wants to grow.
Yeah, absolutely. Thank you, Michael. Michael touched already on the regulatory part. So, Thomas, regulatory onboarding and reporting requirements keep rising. How can the industry avoid duplication, inefficiency, and will tighter regulation actually help or hinder growth?
I think regulation in general helps, right? I think that the regulator, but I think
Any regulator here? Sorry.
I think I want to draw a parallel to the kind of sustainability, right? Where we had SFDR. I don't know who still remembers those letters, but basically it was the regulation behind classifying funds, or is the regulation, how sustainable they are, right? And I think the big issue, and I was product developing in that area, and the big issue was it was not developed from the view of the investor. An investor wanted to know, is this sustainable, yes or no? Is it impact, yes or no? And the EU came up with these paragraphs, right? And I think we see a similar jungle now across the European jurisdictions, across the world, when it comes to private market regulation, when it comes to distribution oversight, but already when it comes to products, right? I, as an investor with my app, I don't care if it's a RIFE, if it's an LTIF, if it's a UCI Part 2, and you know, you have the whole bandwidth evergreen funds. I don't care much. I want to know, what is the fund doing? Is it safe? Like, what is my liquidity? When can I get out after a year or two? What are the terms, right? And I think here the regulation really should become more investor-centric. I think, and then we, the industry, can actually build things, as Michael also alluded to, that kind of reflect these kind of converging standards. And we're already kind of moderating for us that we talk to asset managers that run their funds on the platform and tell them, okay, we have 3 fund processing groups, A, B, C, right? A is going straight through. B takes a little bit someone looking at it, and C is a highly manual trade, right? And if you do this and this and this for your product, you'll land in A, right? So you'll have a better experience, the bank will have a better experience, basically the whole ecosystem. But this requires kind of a joint, unified kind of industry agreement and regulatory guidance.
Absolutely. On the product structures, we touched on that already, and I start with you, Stephanie. Evergreen and semi-liquid structures are gaining traction. Where do they solve client needs, and where are expectations actually still unrealistic?
Yeah. So within the private bank, we're seeing a tremendous interest from our client base in evergreen structures. Why? Because it just simplifies the dialogue a lot. It also simplifies the process. So in terms of cash flow management, that is no longer a task which the client himself needs to do. That's done within the fund. Collateral management falls away. Subscription process is much easier. So a lot of benefits. However, where I think there is still a bit of a misperception is on, I would say, liquidity match, or rather liquidity mismatch, because there is different levels. There is, on one hand, strong growth and interest from investors who are pooling their capital into the funds. And then on the other hand, there is the GP who actually has to, in line with that growth, allocate the capital into interesting investment opportunities. So we pay a lot of attention in our selection process and in dialogues with our GPs to understand, do they have the experience to handle those different levels of liquidity, and also do they have the access to the relevant deal flow.
Great, thank you. I would, Lulu, would you like to add something, and then Michael?
Yeah, absolutely. Thank you. I think the evergreen really can solve a problem in terms of accessibilities. Rather than you have to be a very small, closed club to access to certain fund at a certain time, which only lasts for 6 months or 12 months. So evergreen basically offer you the kind of long term, right? So you also know the existing asset already, so therefore increasing transparency, therefore the confidence to invest in prime market. Now, I think evergreen structure is good, but also I think very important semi-liquid. So therefore, instead of traditional, you have to lock out your capital for 5 years, 7 years, or indeed 10 years. Most semi-liquid structure in the market now offering quarterly dealing. But I entirely agree with Stephanie, so there is expectation. So therefore, monthly and quarterly out, I think that's as liquid as I can offer just now. So therefore, the lot of demand in terms daily pricing, monthly dealing, I think there's some kind of misjudgment on this. So therefore, managing liquidity from a GP perspective, I think itself is really a task. So therefore, partner with a certain investment teams with huge amount of track record and experience, I think is absolutely vital when you actually consider investing to private market. Thanks.
Thank you, Michael.
So where are semi-liquids delivering? Where are they over-promising? I think, number one, a couple of numbers. So globally, if you're looking at the global equity market cap, 20% of the global equity market cap is today private, 20%. 10% of the global market cap in credit is private. So 20% equity, 10% credit is today private by market cap. So if you take a traditional client portfolio, 60-40, equity and fixed income. So 60% equity, 20% private is 12%. 10% on 40s is 4 additional percent. Makes it 16% allocation if you are market neutral to the global market cap. 16% allocation to private markets. Today, in private wealth portfolios, if you exclude the ultras, you are below 0.5%. Below 0.5%. So the question is, what vehicle do we use as an industry to get our clients, even if they don't have a view? Because it's our responsibility to get them to the global market cap as an industry. Even if our clients don't have a view, how do we get them even somewhat close to that 16, 15, 12, whatever that real number is, but it's somewhere there. It's not a closed-end vehicle, that is for sure. If you're excluding the ultras, a mass affluent, a retail, a high net worth client, they don't want to get capital calls, and the wealth managers and private banks don't want to take the credit risk to administer them if you are not a 250 million wealthy individual. So the instrument to get the allocation to closer to where it should be, measured by global market cap, is semi-liquid. There is no other. Or our clients are not going to get exposed to the growth of the future trends. ChatGPT, AI, European defense industry, whatever this is not publicly available. So I have no doubt the instrument is semi-liquid. Now the question for us all here is, how do we implement it?
Yeah.
And the implementation is semi-liquid. It has to be.
Yeah. And we talk about that right now, so that was a good bridge. Thank you, Michael. Thomas, technology is often presented as the solution to these operational challenges. Where so far has it delivered tangible process, but where is still the gap between, let's say, promise and reality?
I think it's in adaptation, right? I mean, if I look at us, the main platform that I alluded before is called Vestima, right? This is where the 4.5 trillion of assets, and we now upgraded it. We have an overlay, it's called Vestima Digital, right? And this, we're now running the pilot with Standard Chartered, for example, or a partners group on the asset manager side and some others that are not yet disclosed. But in theory, we can process and collect all the necessary attributes that we touched on the investor level, on the trade level, also solve the topic of the omnibus, kind of have a disaggregation for the asset managers that want to kind of look for you. You see where the assets into your movies are coming from. So in theory, we can do this, and we're getting there, but I'm with Michael, it's an ecosystem, right? The industry needs to plug in. And many of the banks, they sit on Cobalt IT systems, right? I know because I worked in UBS Credit Suisse, but it's true for many of the others. So you need APIs, you need plugins to make it, connected through to the last mile. So I think that the gap is, I think also with DLT and other technologies, I think we have the tools. I think we just need to work together as an industry to scale it and to bring everyone on a joint standard, joint platform, and then we can process it.
Yeah, I couldn't agree more. Yep.
I was just saying, Michael is nodding. So, is there anything from your angle you would like to add?
I think we understand where the problems are. We clearly articulated them. The solutions are there. It is now connecting our clients to the right pipes.
Yeah.
Everything else is quite frankly is there. So yeah, I agree.
Lulu, as in your responsibility as research, is everything there, or are you missing something?
I think we're living through a huge, exciting time in terms of technologies. I mean, technology creating transparency. So believe it or not, I was at a Bloomberg event a few weeks ago. So 47 years ago, when Bloomberg set up business, they're still using paper trading bond. So I'm sure we don't need a 47 years to actually solve this problem.
Yeah.
So we built an in-house system called Prism, because technology called Prism, where we can monitor our portfolio daily. We can gather in all the information relative to our portfolio using AI as well. So I think that amount of transparency which we can offer to our investor would again bring the transparency to the investor, giving investor confidence to see what they actually invested in, and indeed the wrapper for semi-liquid structure. I think I'm really generally very excited about the future ahead for private market. Thank you.
Excellent, very positive outlook. Stephanie, from a fund selection perspective, which client types are best suited for which structures, and where do you still see mismatches? We touched on that a little bit already, but...
Yeah, so in my opinion, actually, of course, semi-liquids gaining a lot of traction at the moment, but also closed-ended should not be forgotten. I think there is really certain client segments who are better suited for one or the other. Certainly institutional clients, in my opinion, should continue to use the closed-ended structures. It can be much more niche strategies, more tailored solutions. So that's on institutionals. On the wealth client side, I think for family offices, what we very often advise is that they use semi-liquids for a fast build-up of NAV exposure, like you said, to reach a certain threshold in an overall asset allocation, but then actually take a multiple-year, very systematic approach to bring in closed-ended solutions as they would have before. So, and then there is the smaller segment of private wealth. Of course, their semi-liquid solutions are very suitable, because with a small ticket of 125,000 or a little bit more, you can get really a diversified exposure to an asset class, with also recurring exposure to future vintages, which you wouldn't otherwise.
Yeah.
So it really depends, and I strongly encourage as well the investors actually to continue to use both structures.
Yeah, good advice, thank you. Thomas, if you could solve one structural problem in private markets overnight, what would it be?
Yeah, one wish is always hard. So I thought long about it. And I thought, I mean, the key problem is illiquidity, right? But it's a paradox, because at the same time, it's a feature. It's why we are buying private markets, right? And I think to get a broad understanding what illiquidity is, and I want to give a picture. There's this story about some blind people that are touching an elephant, right? And one is touching the leg, he thinks it's a tree. The other one touching the back, he thinks it's a rope, right? And I think the different participants in this industry, like be it the transfer agent, the investor, the banks, like everyone is currently touching the elephant in the dark and thinking it's a different animal, right? Or a different thing, right? Yeah. And I think this joint understanding, starting from the investor level, that the investor knows the product that he's getting, and then kind of going through the industry, I think that would be my wish, that we jointly agree kind of what illiquidity is, that it's communicated in the right way, and that the systems are built appropriately to handle it.
Okay, thank you. Anybody else has a wish? Just asking. Yeah, please. We're good at time.
It's what would make it faster is if everyone would write their legacy systems in COBOL, so I would have to build the interfaces to client systems only once. But that's not the case. So what we're basically finding is different legacy system environments on different platforms, different banks, different wealth managers. Everyone has their own, for whatever reason, system environment and process in place. However, and you said it, technology is making us so much faster to build those interfaces. So my wish would be that everyone would sit on the same front-end infrastructure, and every advisor would use the same advisory process, and everything would be the same, so we could scale up from one day to the next, and everything would flow through, and the clients would be in their client portfolios at 16% where they should be tomorrow. That would be lovely, but it's not going to happen, so I have to go client and wealth manager and private bank by private bank. But technology is helping us to make this a lot more painless than it was in the past. So.
Super. So now my wish is, I'll bring you all in now for the questions. I promised you we have enough time, which we have. We have another 10 minutes left. So I would like to encourage you to ask questions to our esteemed panel. Who has one? Not all at once, please. While you're thinking about a question. We might as well get... excuse me, sorry. We need a microphone. Sorry. No, it's recorded, so that's why we need the microphone.
Question, the LTF 2.0 impact. So the difference between the pricing and valuation. Do you see currently the issues with clients starting to look at expectations from when you price and at what pricing and how you sell the last month's menu at today's prices?
Anyone in particular, or?
General, because it applies both for the
Okay.
private clients and also for the infrastructure.
Right. Who wants to start?
Sorry, can I just clarify? Is it dealing with basically the lag of pricing in terms of valuation? Right, okay. Intuitively, any private market asset across any shape or grades, those are quarterly valuation. When you see quarterly, most of them, as Stephanie pointed out, probably 6 monthly or yearly. But equally as all the public markets, public equities, those companies not being valued every day either. So therefore, the huge differential between private market and public market, in my eyes, is public market in terms of pricing is transactional. Every day, every single, you know exactly what Microsoft pricing is.
The next trade is the price.
This is a trading price. It's transactional.
Yeah.
Where private market, our trading based on valuation.
Yep.
So therefore, fundamentally, how much value those assets are, those companies worth. So therefore, naturally, there will be lag for this to be published. But in terms, Michael said there's all standardizing issue. So therefore, different country, different sectors, or indeed some are benchmarked to the public market, for example, private equities, private credit in certain ways. But real estate infrastructure, those are very, very different. So therefore, naturally, there'll be lag. So hence the illiquidity premium you're also getting by investing into private market. So therefore, I think the technology will solve some of the issue there. But I think in terms of valuation front, I think as long as you're in private, so therefore your fundamental will driven by valuation rather than transactional.
Yep.
Does it help?
Yeah, I would also add that it's not LTIF 2.0 specific. I mean, there's also the topic with the continuation funds, right, that are kind of recycling some of the assets. So valuation has always been a topic in private equity from the start, right, from the origin story.
And on the LTIF 2.0, if I may add, what LTIF 2.0 changed is really LTIF is the accepted standard on the continent. Like where LTIF 1, you had a subset of providers. I was at BlackRock at the time. We were one of the 3 first ones through the door launching the first LTIF into Europe. It wasn't really ever broadly adopted. LTIF 2.0 is different. If you go to France or if you go into Germany, this is the widely accepted instrument of choice to bring private markets to retail and wealth, 100%. And the launch numbers show it. There's hundreds of LTIFs 2.0 available in the market now. So.
And I would also say it's more of a cover above a structure or a fund which already was in existence or can exist also without this LTIF cover.
Correct.
So it's more to make it more accessible to retail clients in Europe than really much of a difference when it comes to underlying assets. It's still private companies with a long-term also investment horizon.
Thank you.
So therefore,
Thank you so
not
much.
in a patronized way, I think education is very important.
Yeah.
Not just to our investors and also to the regulators, to different players in the market. All of us here really in absolutely one goal here is how we can actually making those high potential investment, longer term with the patient money to be able to access to this kind of market. I think educational piece is definitely something we can join force on.
Yeah, you were reading my mind, so that would have been my question if nobody has one. What education do we actually need? But I don't want to skip anyone if there's another question. Yes, please. Wait for the microphone, please. Just again in the front row. The exciting front row.
Thank you. My question is about the exit, if we can touch base more on the exit from private markets.
Exit to where?
To public. Like if we can touch base more on that phase.
So I may comment on that more from a current environment. So exit, it can be to public, but then as well, especially when you're investing in the mid-market, there is actually multiple different ways to exit the company. So it can be to strategic buyers, but also to financial buyers. Now in the last couple of years, the secondary market has grown a lot. So trading assets between different private markets managers by entering at a discount to NAV. So it's quite a spectrum exit, for sure currently a big topic, because in the last years, the distributions were below expectations in a lot of the cases, given the entire market environment was challenged, little transactions took place. But again, there I think it depends where in the market you invest. So what we recommend our clients, and also what our asset management arm, LGT Capital Partners, is very strong about, is working in the middle market, which actually provides more optionality when it comes to exit.
Thank you.
Yeah, I mean, just from a personal investor's perspective, I think one of the things to watch as an investor, right? How are the dynamics there? And the second one is kind of the dry powder, right? Kind of the money that is on the sideline that wants to get in and after the deals. And the second one, as you said, kind of how is it getting out? I think from a macro view, if you look at investing, I think that's some two KPIs to watch.
I think the IPO market has been slower than previously. So I think that's impacting in terms of pace, the size in different sectors as well. So that's, I think, the linkage between public-private, especially in the private equity landscape. However, seeing this in the last 20 years or so, there tend to be private companies staying private for longer as well. Yeah. The size actually getting much more significant. So therefore, I think this is really a different,
or don't want to go public at
environment.
All.
Yeah, indeed. Yeah. So if you can stay in the private hand, you basically have a long-term goal to achieve, then why would you like this kind of huge volatility, which in today's market, clearly is, every day there's lots of black swan event going on just now. So I think on top of IPOs, all the exit multiples, which that's I touch on in terms of valuation principles as a manager, which we work on day-to-day basis. I think overall, really the longer private scenarios, I think going to play in the next 10 years or even longer. So therefore, more opportunity to invest in private.
So we have time for one more short question to one person. Yes, please. Microphone is coming up.
Question to Michael. You mentioned that the industry and the ecosystem has to come together. Mm-hmm. How do you see consulting firms outside playing a role in this? We are very curious. We are struggling as we speak.
Yeah, I think, I think many consulting firms will be present in the wealth managers and private banks who I'm talking about. So these are your clients already. I think, and that conversation is not for everyone, because as I said, this conversation only is felt once you're trying to scale up your private market trading, right? If you just have one trade a month, you're not going to worry about too much whether you need to talk to me to build an interface and track it automatically and have a process and auditable and so on. So there's a subset of clients and wealth managers who need solutions because they are actually bought into the vision of private markets and client portfolios. So these, first of all, the industry of consulting can help us find those interested wealth managers and private banks, number one. And then, quite frankly, and I'm in the middle of our pitches every single day, it's very, very difficult to find the right person in these organizations because the head of private credit doesn't know how the private credit is traded, and you probably know that very well. So finding our way around and talking to the right people, making our case for scalable, automated system environments, which ideally have a 0% error rate and everything is flowing through. I mean, you can help the industry, you can help us connect us as an industry to the right clients whom we need to talk to.
Great, thank you. Super. And I'm sure this discussion will continue also in the break. Unfortunately, we are at time. Now, as we close, we do a quick fire round. This means you're only allowed a one-word answer. Are you ready?
Yes.
I start with Thomas that way, and then we go that way around. So it's getting a bit speedy now. So, number one, tokenization of private assets. Real or hype? Thomas.
Real.
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 Real, we're happening in Hong Kong just now as we speak.
Very real.
Fees over the next 5 years. Up, down, or unchanged, Lulu?
Down,
Down.
unfortunately.
Down.
Down.
Has anyone ever seen anything going up in fees? I haven't.
It's one word.
They don't even charge
One
performance
word,
fee
don't
anymore.
take the energy out. Discussion later. Thomas, up, down, or unchanged?
Unchanged but differentiated.
Super. Evergreen structures, Thomas. Game changer or boomerang?
Game changer.
Door opener.
Game changer.
Game changer, definitely.
AI in private markets. Hype or here to stay, Lulu?
Hyper. Stay forever. I'm just testing you, you're listening to me.
That was the check.
And you passed.
That was a check, yeah.
Stay. We're using it today. It's here.
Stay.
Yeah, stay.
In one word now, what are you most optimistic about? Thomas.
Illiquidity.
Investment universe.
Adoption.
Niche to mainstream. We are here to stay.
Super, thank you so much. So thank you all for being an engaged audience. I think next year at FINANZ, we will revisit this conversation and see how much real progress has been made. That was an invitation to the organizers to bring us back. And I hope if you vote for us, you bring us back too. So thanks a lot to the panel for the open debate. Thank you for being such an engaged audience. Enjoy the rest of the conference and all the
Thanks to an
operations.
amazing
Thank you.
moderator.
Thank you very much. Thank you.